Okay, so over the past week, we've introed M&A, mergers and acquisitions, M&A modeling, and we focus on two basic types of models, right? We focused on the acquisition of assets and the divestiture of assets. So use chapters 2 and 3 to become familiar with all the different types of accounting methods for that, where remember the key is in an acquisition of assets, really the price paid sets the value of that asset. So whatever, if you bought an asset for $25 million, it gets recorded on the books for $25 million, and then you have to raise debt or equity accordingly to fund that asset, right? And then we contrasted that against divestitures, where you really have to be responsible for the actual value of the asset, right? So sometimes you'll receive cash that's greater than or less than the net value of the assets on your books. And that becomes a gain or loss on sale. And we step through the accounting for how to handle that, and how do you handle that in the modeling. And it's a little bit different. It's sort of one-off, right? It's not as seamless as an acquisition where you raise equity, you raise debt, and we know how to do that now, and then cash goes out and the property goes up. Real simple. And in divestiture, there's an extra twist, because if you're receiving cash that's greater than the property that's listed at whatever its value is listed on the balance sheet, there's a difference between the cash received and the value, and that difference becomes a gain or loss on sale. And so in short, we record that gain that impacts your net income, and then we have to reverse that gain in the cash from operations. We reverse it because it's non-recurring, and we reverse it because we don't want to double count. What do you mean double counting? Well, we record in the investing activities the monies received for the actual price paid. So in this example, we received $15 million or $15,000, I think, for the asset, but the asset was worth $13,000. So if we didn't make this gain on sale adjustment of 2, our total cash flow would have been 17, 15 for the money received, and then the additional 2 because the gain on sale flows into the net income. So in order to avoid double counting, we need to reverse that gain on sale. And that's how, at the end of this example, and I'm just recapping quickly, the cash goes from 0 to 15, but the truck only goes down 13. It doesn't go down 15. It can't go down 15, otherwise you'd have a negative PP&E. And it's balanced by the shareholders' equity. That's the acquisition and divestiture, simple acquisition, simple divestiture accounting. Any questions on that? I'm not really going to get into that anymore. Okay, then we spoke about the difference between an acquisition of assets versus an acquisition of equity. And in its simplest form, when you're acquiring assets, right, we spoke about how to mechanically do that. But what if you want to purchase the entire entity? And if you purchase the entire entity, the accounting is a little bit different. The thought process is different, right? However, it's important to note that when buying an entity, a business, you can treat, for accounting purposes, the acquisition of that business as just an acquisition of its assets or as an acquisition of the equity of the business. And there's two different perspectives on that, right? If it's an acquisition of assets, generally you're buying all the core operating assets of the business, maybe non-operating assets of the business, and the liabilities most directly associated with those assets. How does that differ from an acquisition of equity? And what benefit does it bring? What do you guys think or remember? If it's an acquisition of assets, what's the big benefit? Or explain how that differs from an acquisition of equity. Start there. Right, an acquisition. So if you're the benefit, the true benefit, well, first of all, the acquisition of equity, you're acquiring the whole business, the entire business, all the assets and all the liabilities. So in other words, number one, in an acquisition of assets, maybe you can kind of handpick the specific assets that you want. That's one. Two, in an acquisition of assets, because of what we spoke about, the nature of an asset, the price paid is going to be the new, more or less, right? There's some exceptions, but the price paid is going to be the new value. You will most likely, all of those assets would have some sort of depreciation value to it. And there's a benefit there of depreciating those assets. Right? Whereas in an acquisition of equity, and we'll see why, you're basically, the monies paid represents the total assets less the total liabilities of the business which is representative of the shareholders' equity of the business. So any money that you've paid greater than or less than that shareholders' equity of the business needs to be accounted for. You can't just step up. You can't, if I buy a business whose shareholders' equity value is $100,000 and I pay $200,000 for that, from the accounting purpose, what I'm doing is I'm taking all the assets on the balance sheet of that target company, all the liabilities, and I'm adding it into my business. So what happens when the money paid is greater than the value of all the assets less all the liabilities? There's a gap there. There's a difference, and that becomes goodwill. Right? In an acquisition of assets, if I'm paying $200,000 for $100,000 in assets, basically I just write up those assets. The assets go into my PP&E as the price paid, $200,000. There's really no gap. What's the benefit of that? Then I get a greater value in PP&E. I get more depreciation, tax deduction. In an acquisition of equity, again, if I'm paying $200,000 for assets and liabilities that's worth $100,000, I don't get to write up everything as PP&E. Why? Because the idea of equity is that difference could be intellectual property. It could be a lot of other things. We record most of it as goodwill, and you don't, in U.S. GAAP, you don't depreciate that. You can't. It just sits in your balance sheet, so you don't get the tax deduction. So, the seller usually always wants to treat the sale as an acquisition of equity. He wants to get rid of everything, right? The buyer usually wants to treat the sale as an acquisition of assets if they can, right? Why? Because they get that step up. So there's a third option when performing an acquisition called the 338 H10 Election, which is kind of the best of both worlds scenario, where the seller is basically, you're selling the whole equity, you're treating it as a sale of equity, and the acquirer can, even though they're purchasing the entire equity of the business, they can treat the entire purchase as an acquisition of assets. So there's no goodwill, so everything gets written up as intangible assets or as PP&E, which you can all depreciate or amortize in some way. And that is allowable only under certain conditions. These conditions change a lot, but you really don't have to know this much. But if you're acquiring an S corporation, not a C corporation, an S corporation is a smaller corporation. There's limitations in terms of how much shares you can distribute, et cetera, et cetera. If it's an S corp, you are allowed to file for this 338 H10 Election. So a lot of times in the private equity world, they do this because a lot of times in the private world, they're not buying big C corps, they're buying smaller S corps. And it's also allowable if you're acquiring subsidiaries of large businesses. That's the general rule, but really, it's a lengthy process to file for this 338 H10 Election. This is one of the sticking points for a leveraged buyout. And it's usually done on a case-by-case basis. You get like a tax lawyer to an accountant to try to fight for this approval. But it's important to know, it'll be on the M&A exam, 3 methods of acquiring businesses, acquisition of assets, acquisition of equity, 338 H10 Election. You got to memorize that. You'll be asked that in an interview. So I'll mention this 2 or 3 times, and people still get it wrong. Make sure. Okay. Any questions? So from here on out, we're going to talk about an acquisition of equity. We spoke about acquisition of assets, how it's performed, right? Value all the assets, write it up as PP&E. Acquisition of equity is a little bit different. So when you're acquiring a business and thinking about the acquisition of equity, there's really a few things you're concerned about. Most commonly, you're concerned about in the beginning, what's the impact on my earnings per share? Because that's what shareholders want to know, and you need to garner shareholder interest in order to approve on the merger. So a lot of times for analysts, you want to see what is the impact to an acquiring company's financials when absorbing a target business. When an acquirer merges with a target company, what is the impact on the acquiring business? What is the impact on earnings? Also, what's the impact on credit and some other ratios? But we're going to first learn what's the impact on earnings per share. So the 2 common methods of analysis that you look at is, this is a mini merger, really formally an accretion dilution analysis. Mini merger is the small 1-page model that we will build together. I sent that template to you a few weeks back. We're going to build that. The second is a full-scale merger model where you have a fully working acquiring business, income statement, cash statement, balance sheet, all the supporting schedules, a full target business, and you're merging them together sheet by sheet. So to give you an idea, over the next couple of weeks, we're going to spend the next 3 days on mini merger modeling in various forms. We'll put together the one-page analysis. I'm going to do a few paper analyses because if it comes to be a written case study in an interview, you will see it that way. And there's very different forms of seeing it. This week will be indicative of what you'll see on the M&A exam. Next week, we'll go through a full-scale merger model, just a template first, before getting caught up in the nuances of real companies, which will be Office Depot, Office Max. I want to show you first round how you just merge two fictitious companies so you know the mechanical process. We'll do that next week. Remember, next Monday is the exam on DCF. And then the following week, we'll start the part 2 of the book, 3 of the book. We'll do the full merger Office Depot, Office Max. That'll take a few days, maybe 3-4 days, maybe even more. And then we'll get into leverage buyouts. That's what's to expect. Questions on what to expect? Okay. So we're going to start with the mini-merger modeling, the mini-merger analysis, or the accretion-dilution analysis, which in an acquisition of equity helps to determine what is the impact on the earnings per share of the acquiring business. Just quick first-cut analysis. So for practical purposes, it's helpful because before even building a full model on each acquirer and the target business and merging it all together, that might be a waste of time. What's the even remote impact on accretion or dilution from a financial perspective? So sometimes when you're working with an acquiring business, if your client is an acquirer, some of you guys I think are working in this type of situation, where they don't know who they want to acquire, they might have 5, 10, 15 companies in mind, and they want to know the financial impact. Well, it's certainly going to be painful to do 15 full-scale merger analyses. It's much simpler to download key metrics that focus on earnings per share, EBITDA, depreciation, EBIT, taxes, earnings, and do a quick earnings per share analysis on 15 companies like you would do your comps. It's a lot quicker. So for practical purposes, you look at accretion dilution analysis before diving deeper into a full scale. And for instructional purposes, it's great because it really focuses in on the major drivers behind what impacts accretion dilution before getting lost in the complexity of a full-scale merger model. So this goes back to what I mentioned in the beginning of class and really your interviews. The mechanics of a full-scale merger model is actually not too complicated when you see how it's done. All right, it's income statement, and it drives the cash flow statement. It's very similar from a general perspective to a full-scale model. But if somebody steps back and say, well, what are the major differences? Or what's really driving earnings per share in a full? When you're looking at the way a full-scale merger model is done, it's hard to see the major impacts and drivers, right? This brings it to light because it's all done on one page. So it's great when somebody asks you, well, how do you do a merger model? You can have this and kind of picture this in your mind, a quick one-page analysis in terms of how's everything laid out. We'll look at it this afternoon after the break. So you're really looking at what the impact is to earnings and to shares, because earnings per share is based on earnings divided by shares. So we'll look at that. Before we get into the actual transaction, it's important to think about major steps to a merger analysis, whether it's accretion dilution, whether it's full scale, even if it's a spin-off or a split-off or a buyout, any type of restructuring, you want to think about it in these 3 steps. First of all, what is the purchase price? What's the value of the business? So I think a lot of you guys, when working on maybe you're staffed on a buyout or an acquisition, and you're just modeling the acquire, or you're just modeling the target, or in the beginning that's what you have to do, you have to value it, and you're probably thinking, well, why do I have to value this business, right? Well, if it's the acquirer, there's a different reason for that, because the acquirer needs to raise equity and they need to value how much of the equity is going to be, right? Or whatever other reason it would be. We'll look at that when we relate this to Office Depot, Office Max. But for the target company, you've got to find out what it's going to be worth. How much can you sell it to a buyer? Or if you're the buyer, how much you're going to purchase for it, how much you're going to negotiate. You need to just do a core standalone model and figure out what the purchase price is going to be. So you do a whole valuation analysis, everything that we learned in the first course, and we try to come up with what the purchase price is. That's step 1. There's a little bit more complexities to it. We'll look at, we'll do some examples quick examples of that. 2, sources and uses. And the sources and uses lay out how much do you really have to fund for the company, how much money do you have to put up, and it's more than the purchase price, we'll look at that. And how are you going to source those funds? Cash on hand, raising equity, raising debt, where's the debt going to come from, where's the equity going to come from? That's the sources and uses of cash. And then 3, the pro forma analysis and adjustments. These are the 3 major steps. This is the process for M&A from a technical perspective. So, purchase price, we just spoke about. You've got to value the business. I'm going to get to what this means from a public or private company in a second. Sources and uses, a little bit more detail. How am I going to pay for this? So the uses, just think about, what am I paying for, right? And the first thing you're paying for is the purchase price. What does the purchase price represent? That's kind of an open question, but what do you think the purchase price represents in your mind?
The value of equity.
Which equity? What specifically?
The equity of the target company.
Yeah. And who holds that equity? Shareholders. Right? The value of the shareholders. So the purchase price typically needs to be set at a premium, commonly called a control premium, to convince the shareholders to give you their shares. Okay, that's the purchase price. Right? So you're paying for the purchase price, which is at a premium. And remember, sometimes we talk about the benefit of precedent transactions. It has a premium in there. To help you determine, well, how much of a premium would I have to pay to really convince shareholders to give me their shares. Control premium. But there's more to that, right? Sometimes you will be, as an acquirer, responsible for the target company's net debt obligations. Well, what do I mean by that? Well, if the target company is public, for example, and you're trying to buy out the shareholders, right? Who's responsible for the debt? You can't leave the shareholders responsible for the debt. That's not allowed. So if there's a lender, let's say Chase Bank, that has lent this target company $10 million, and you are buying this business, you might have to be responsible for paying back those obligations. It depends. It depends on several factors. And really what it depends on are the debt contracts. Right? So you would do diligence. So a big process in M&A here is doing diligence on the business, or varying portions of the business. Are the financial sound? Part of the diligence is understanding the debt obligations on that business. And a lot of time, with every debt, there's a contract or clauses or bylaws, they call them covenants, that determine under what terms is that debt allowed. And sometimes there'll be clauses that say, if there's a major company event, such as a change in control, we want out. We want to be paid back. Lenders need to be paid back. So as an acquirer, you need to look for that. And if the target company's debts need to be paid out upon acquisition, as an acquirer, you need to come up with additional funds to pay down the target company's debts. So it depends. And then there's transaction fees. Legal fees and fees related to the acquisition. Paying lawyers, paying auditors, paying bankers, throughout the whole process will add up significantly and needs to be part of the uses of cash. So it's much more than the purchase price, right, at times. So there's several different ways a merger can be structured based on the nature of the purchase price. And this is something to consider. So when I go back to this slide, and this will focus on a little bit more in LBOs, based on the nature of the company, you can infer what the uses could be, maybe. So in other words, the uses are in 3 major categories: purchase price, net debt, transaction fees. The net debt responsibility may or may not be on the acquirer's hands, or not, right? It depends on several things. That's what this table is supposed to lay out. If it's a public company, first of all, the acquirer must maintain responsibility for the debt. Doesn't mean they have to pay it down, but it means they're responsible, right? If it's a public company, can't leave it with the seller, can't leave it with the shareholders. If it's a public company, you have to be responsible for it. You would look at the lender's covenants and determine, will I have to be responsible for paying down those debts? If I do, then the value of the net debt becomes part of the uses of cash. I have to raise additional funds to pay it down. If not, and when I say if not, that means those lenders are okay with keeping the debt on the balance sheet and transferring them over with your ownership, then you don't have to include net debt in the uses of cash. Right? The net debt will stay on the business's balance sheet. You don't have to pay it down. You don't have to raise additional funds to pay it down. So that's where you have to kind of do a little bit of research. As an analyst or as anybody in the beginning of a transaction like this, it's impossible to get a handle on those covenants. Well, maybe it's possible. It's unlikely that you'll get a handle on those covenants. It's unlikely that you do the research. So we usually conservatively assume that you have to raise additional funds to pay down those debts. And if later on down the due diligence process you realize you don't have to pay down those debts, then great. It'll be cheaper. It'll be less impactful to the EPS because you have to raise less funds. So we usually just assume if it's a public company, you have to raise additional funds. But just note, it depends on diligence. Now, what if the company is private? If the company is private, there are actually going to be 2 or 3 owners of the business. The debt can go either way. You can buy the business and leave the debt with the seller if you want. And in reality, if the company is public, it's very, very unlikely, but there are ways to structure an acquisition where you leave a shell entity with just the debt there, but usually shareholders won't approve for that. So technically, in a public company, just a little disclaimer on the side, maybe there's a structure where you can leave debt in the shell, but I don't see shareholders ever going for that. Anyway, in a private company, you can basically negotiate with the owners either way. Now, how do we come up with a purchase price? Several methods, right? If it's a public company, the purchase price is based on what? Usually.
Market cap.
Market cap? What else? Based on, which is based on what? Sorry, just trying to see the line. Which is based on what?
Stock price.
Stock price, right? Stock price, right? Equity, paying for the equity. What about if it's a private company? How would you value the price? How would you price the business out? Several different ways, but give me some. DCF gets you to what type of value? Enterprise value, and that's, how do we negotiate that with the seller? What metric do we use? Multiple of EBITDA. If you're negotiating with a multiple of EBITDA, if you do multiple of equity too, but if you're negotiating with a multiple of EBITDA, how does it differ from the purchase price? You kind of just said it, but
That includes the debt.
it includes the debt. So you got to be careful. So I see a lot of analysts kind of botch that up a little bit. And this is more pertaining to LBOs usually. Because in M&A, especially with you guys, what you're doing, it's usually you're seeking out public companies. But in a buyout, it's usually private companies, except for the big ones, which are far and few between. If it's a private company, it depends on, or you have to be concerned about how you're negotiating for that purchase price. If you've negotiated an enterprise value to EBITDA, if you're negotiating the purchase price based on enterprise value to EBITDA, you're basically negotiating for an enterprise value, which is the value of the business, including net debt. So if I went to a seller and said, I'm going to pay 10 times EBITDA for your business, and their EBITDA was $100,000, so I'm paying $1 million for your business, that includes the value of debt because that's an enterprise value, because you base the value off of an enterprise value to EBITDA multiple, which you're basically saying, I'm giving you $1 million, you're taking the business, and you're going to pay down the debt. So if you take that $1 million in your uses table and you add net debt to that, you're double counting. That $1 million already includes the value of net debt. Make sure you understand that. If the purchase price is based on an equity value, which is the stock price is equity value, right? Stock of a company is after lenders have been paid. It's the value of the business after lenders. Then you have to consider, do I have to be responsible for the net debt? If your purchase price is based on an enterprise value, that's the value, the equity value of the business plus the net debt. You're basically giving the owner the equity value of the business, what do you think the value of the equity is worth, plus the value of the debt. So he's paying off the net debt. I'm going to give you a couple of interview examples that will flush that out. You'll understand that better as you start modeling it. But just start, and I'll repeat that a couple of times. So generally, uses of cash, purchase price, target net debt, transaction fees. This is all Chapter 4 in the M&A book. Chapter 5? Forgot. Accretion Dilution chapter, I think it's Chapter 5. So read through it over this week. Sources, how am I going to fund all this? And it's a combination of debt and equity or excess cash on hand. How am I going to fund this? Debt, equity, cash. Any questions so far? No? Good. Okay. So now what? I have an acquiring business. I want to buy a target business. I'm going to acquire more than the assets. I'm going to treat this as an acquisition of equity. So what does it do to my financials? And I just want to think about the balance sheet first, because the balance sheet really represents what's owned, assets, liabilities, and shareholders' equity, even though the accretion dilution analysis is kind of an EPS impact thing. Just to think about what are you getting and what are you paying for. So you're really paying for the shareholders. You're raising money. The purchase price should represent paying for or paying off the shareholders. You're trying to raise money to convince the shareholders to give you their shares. And that's usually at a premium. So we got to figure out what to do with that premium. So what you're paying for on top is the shareholders' equity at a premium. That represents the purchase price. You're also paying for, assuming, we're going to conservatively assume that you're responsible for the net debt. That's the more complicated option. You're also paying for the net debt. And when I say net debt, I say net short-term debt plus on debt minus cash, because I'm going to assume that the cash that's left over in the target business will be used to pay down the debt. So if you think about what you're paying off, you think about the balance sheet structure, assets, liabilities, shareholders' equity. Shareholders' equity is going away. They're gone. Right? Net debt, gone. Paid it off. So you're getting everything else. You are paying for everything else is what's coming onto your balance sheet, which is the total assets, excluding cash, right? Cash went to pay on debt. You're getting the AR. You're getting the inventory, prepaid expenses, right? The total current operating assets you're getting. PP&E, you're getting. You're getting total liabilities, excluding debts or obligations that have been paid off. So the accounts payables, the accrued expenses, deferred taxes, maybe. That can be negotiated separately. We'll talk about that. That's complicated. That's basically what you're getting. If you think about that, that's pretty much the operating assets of the business. Right? That's pretty much PP&E and working capital, right? This all goes back to valuation. What's important when you're valuing a business, right? Why do you look at, we went back to all this valuation methodology, because you're really concerned about the operating assets of the business. That's really what you want to obtain. And then other things happen, which we'll drill into in a second, right? What other things happen? You know? Can you guess? We talked about it before. Well, so in short, of the target company, I'm getting everything, except for the line items relating to debt and equity, because the debt's been paid down, and the shareholders' equity you've paid off, assuming that we're going to pay down the debt. So really what we're going to do when you're taking on a target business is you're going to add. You have an acquiring business model, you have a target business model, and assets all the way down shareholders to the bottom of the balance sheet. You're adding line by line, acquire plus target. You're just basically taking on the target's information. You're adding the target accounts receivable to yours. You're adding the target inventory to yours. Prepaid expenses to yours. You're taking on everything about the target company except for items dealing with the target debt and the target equity, because the debt you pay down, the equity's gone away. You got to commit that to memory, make sure it makes sense. On top of that, other things are happening. What else is happening? What can you infer in an acquisition? What happens to the premium that we've paid? We paid more than what the shareholders' equity on the target company was worth. What happens to that gap? Goodwill. We're creating goodwill. I'm just scratching the surface, high level. I don't expect you guys to get it yet, but once I start to repeat this, after we've built the model, after we've done examples, it'll slowly start to sink in. We've got to start somewhere. Goodwill. What else happens, do you think? How are we funding this? How are we funding this? Equity. We're raising equity. We're putting new equity into the balance sheet because we have to raise new equity to fund this. What about new debt? We have to raise new debt to fund this. That's the general idea. So again, when you're buying a target business, you're paying for the shareholders' equity, paying it off, paying for the debt, paying off the debt. That's an assumption. Let's say you're getting everything else. All the assets minus the cash, all the liabilities minus the debt, that's it. Right? But the problem is the value of all this stuff, right, the assets less the liabilities, which should equal the shareholders' equity, the price that you're paying is greater than that. It's greater than the shareholders' equity. So there's going to be a gap. So when you're taking on all the assets and all the liabilities, and then you record that you paid a lump sum that's larger than that, where does that gap go? It goes to goodwill. More or less. There's a little other adjustments, but that's the general. So what you're doing is you're adding together line by line, acquire plus target, assets, liabilities, excluding cash, excluding debts. And a few things are happening. You're recording new goodwill, recording new debt if you're raising debt to pay for the business, new equity if you're raising equity to pay for the business. That's the general idea. That's the high level. So when thinking about translating that into an income statement, how does this happen for an income statement? Right? If I want to record or estimate what the pro forma impact, what after the transaction impact is of acquiring a target, and I'm the acquirer, what do? It's the same general concept. You are adding together, line by line, revenue all the way down to net income of the business, except for items dealing with the target company's debt and the target company's equity. So in other words, revenue, acquire plus target. Costs, acquire plus target. I'm getting all the target's operations, right? Except for items related to the target company's debt, assuming we pay down the debt, and except for items dealing with the target company's equity, which is what specifically? What line items do we not include? Target shares outstanding. It's gone. Eliminated. Paid off. Shareholders are gone away. What else?
Interest expense.
Interest expense. Exactly. Debt's gone. Interest expense is gone. That's pretty much it. So when you're looking at an accretion dilution analysis, acquire plus target, you're adding together revenue all the way down, costs all the way down. When you get to debt, just acquire only. Target debt's gone. You don't include the target debt. You continue adding together, acquire plus target. When you get down to shares, acquire shares only. Right? But on top of that, you want to think about 4 major adjustments to the income statement based on what we discussed before, based on the impact of goodwill, based on the fact that you're raising equity to fund the acquisition, based on the fact that you're raising debt to fund the acquisition. 4 major adjustments. 1, synergies. Right? Post-merger cost savings. There could be revenue synergies, there could be cost synergies, but the major idea is that when you're combining operations, sometimes there's overlap, and there could be cost. Workforce reduction is one. Maybe you don't need 2 headquartered offices, so you're consolidating there. There's cost savings due to synergies. And we'll talk about the modeling, how to project out and things like that, but just high level. 2, goodwill and intangible asset amortization. So I mentioned a discussion on goodwill. We'll talk a little bit more about this in the full-scale modeling, but just from a high level, goodwill is obviously accounting for the purchase price over the target book value of the business. I am paying a lot more than what the core value has been worth on its books. And there's a lot of reasons why I do that. Market trades at a premium. Maybe the company was for sale in an auction. Sometimes an auction drives up the price. There's impact on branding and things like that. And generally, that gap gets recorded as goodwill. But it gets more complicated. And we'll slowly dig deeper as we get more comfortable with the modeling. But the major difference is a portion of that goodwill can be separated out and allocated to new intangible assets. What's intangible assets? Intellectual property, branding. In other words, you can do this. You can say, you know, back before 2001, when this rule passed, where that everything before 2001, you can pretty much purchase price over book will become goodwill. You can amortize goodwill. So people didn't care about assets versus equity. You can depreciate, amortize everything. And even big companies also didn't care about paying an exorbitantly high number for a business, much higher than the book value. It's like, okay, well, we can amortize all this. We get tax deductions anyway. That's going to save us in the future. The government came down and said you can't do that anymore for a number of different reasons. But there is a portion of the purchase price over book value that you can separate out and allocate towards intangible assets. And the thought process behind that is, well, I'm paying an exorbitantly high number for this business, higher than the shareholders' equity, for some unknown reasons from accounting purposes, meaning maybe this is an auction, maybe I really want the business now, you know, a lot of reasons why. And then also in addition to that, maybe there are some definable reasons, such as I'm paying more for this business because I think the brand is worth a lot more than what's been stated on the books. Or I think there's a lot of intellectual property that hasn't been properly accounted for on the books. And if you come into a transaction and bring an intellectual property appraiser and a tax lawyer, and you can make that case. You can allocate some of that purchase price over book value to intangible assets, and that you can amortize. So you can get some benefit to the purchase price over book. We'll talk about that more. But that's a concept called intangible asset allocation in an M&A situation, and intangible asset amortization. So we're generally, if your purchase price is $10,000 greater than the book value, generally that just gets lumped up as a goodwill. You can say, all right, well, a percentage of that is going to be allocated to intangible assets, and that's going to be amortized. How do you know that as analysts? You don't. So we typically be conservative. We usually, in modeling as analysts, at least it's important to have the mechanics in there so you can adjust for that. And last minute, if an appraiser comes in and says, well, this is what it should be, you can just easily chop it in, you know. So we conservatively assume 20 or 25% of the purchase price over book value gets allocated to intangible assets and amortized over, nowadays it's 15 years. That's just the standard, 15 years. It used to be 40 years, 50 years, the length of like an intellectual property contract. Now it's been reduced to 15 years. It's more commonplace. The modeling purposes, generally from here on, I generally assume 25% over 15 years. And again, from an analyst perspective, it's just important to at least drop in these assumptions so that it's readily available to be changed in a second if an appraiser comes in and says, all right, this is what it should be. That's the point. So why going into all this? Because stepping back, we're getting into what are the adjustments in an accretion dilution analysis. Remember, what we're going to do is in an accretion dilution analysis, you take the acquire and target's revenue all the way down to net income, acquire plus target, line by line, add it together, except for line items dealing with target equity and target debt. No target interest, no target shares. And on top of that, you make 4 key transaction adjustments. Synergies, post-merger cost savings. Make an adjustment for that. Intangible asset amortization. You assume a percentage of the purchase price over book value would increase your amortization. And you make 2 more adjustments. If you're raising debt to fund the acquisition, new debt, you're going to have new interest expense. If you're raising equity to fund the acquisition, you're going to have new shares and maybe new dividends. And we spoke about the impact of debt versus equity on EPS. This is going to play a big role. We'll see this in the model, right? The more equity you raise, usually it's more dilutive to EPS. The more debt that you raise, it's less dilutive. Right? So in general, and I expect you guys to know this now, but I expect you guys to get to know this. So we're going to spend a whole week on this, and then as you learn the full scale model, it'll become easier. But if somebody says, walk me through a merger, now how do you do a merger analysis? Step 1, come up with the purchase price. Step 2, come up with sources and uses. The uses is how am I paying for the business, the purchase price, possibly the net debt, assuming I hold responsibility and pay it down, transaction fees. And then the sources of cash, how am I going to fund it? It's a combination of debt and equity. Then I proceed with the analysis. And the analysis is, I take the acquirer's income statement and the target's income statement, and I add line by line revenue all the way down to net income, except for line items dealing with debt and equity, which means no target interest, no target debt. And then I make 4, on top of that, transaction adjustments. Post-merger cost savings, intangible asset amortization, new interest if I'm raising debt to fund the acquisition, new shares if I'm raising equity to fund the acquisition. That'll give me a new earnings per share. I compare that to the old, and that'll give me accretion dilution. That's it. So you'll slowly learn how to step through that. Chapter 5 in the M&A book reads through that whole thing and gives you an analysis as an example to step you through it. So I'd recommend you reading that over the course of this week.